Yeah, so there are people out there who like to say that, comparing an individual's finances is not the same as finances as society as a whole. Yes, it is the same. The only because they say, well, governments, as long as they control their own monetary unit, as long as
Hmm.
they create their own money, they can never default on the debt. Well, that's true only in name. It, they could not default on a debt because they can print as much money as they need to pay it off. But just like I said earlier, what matters is not the amount of money you have, is how much capital your money is storing. And every time they increase, so if they have to increase the money supply, if they have to print more money to pay off all this debt that they're taking on, they're extracting capital from everybody else in society. So there's no free lunch here. It comes at great cost. And then if governments are running up such high deficits that the debt starts to balloon like it is now, like Japan is crazy, but in the US, it's like 130%, something like that,
Hmm.
debt to GDP. And now interest expense is over $1 trillion a year. And so then central banks are pressured by the government, as you're witnessing,
Hmm.
to lower interest rates to make uh, the debt service more affordable. But like I said earlier, and Jim Grant talking about interest rates being the most important price in the economy. It's the regulator. It's a signal. It's capital markets, in order to function optimally, they cannot have the price discovery mechanism distorted, and it results in inefficient or suboptimal capital allocation. And it's happening because you've got players like the Fed who have no skin in the game. So the optimal or natural interest rate
Hmm.
is that determined by market forces with skin in the game, those who've got something to lose and something to gain. And one of my favorite, or probably is my favorite line in economics, was by Ludwig von Mises. So the central banks have been distorting interest rates they call it the neutral rate. So the neutral rate is the rate that
Hmm.
allows for economic growth without inflation. But because they've encouraged so much debt-fueled consumption and spending over the years,
Hmm.
they have to keep lowering the interest rate to enable the or allow the economy to grow. But neutral rate is being driven further and further below the natural rate, which results in the best allocation of capital. And so Ludwig von Mises said that central banks can deny you the right to receive the natural rate of interest, but they cannot eliminate its existence. So the natural
Hmm.
or optimal rate is still there, but policymakers aren't allowing the market to operate at those natural rates. And thus you've seen productivity growth grind lower for decades, and plus other consequences which we can talk about.